Hello everyone, and a warm welcome to our today's auditing learning session. We are going to start on a new topic, which is risks, errors, frauds in an organization. Risks, errors, frauds in an organization. This chapter has 4 sub-chapters. 1 is audit risk, 2 internal control system, 3 errors and frauds, 4 differences between error and fraud. So we begin with the first sub-chapter, which is audit risk. In this lesson, we will define audit risk. We are going to define audit risk. We are going to define and look at the concept of audit risk. Definition of audit risk. What is an audit risk? Now, audit risk is the risk that the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. In simpler terms, it is the chance that the auditor uses a clean opinion when in reality the statements contain significant errors or fraud. So that's the meaning of audit risk. Audit risk is the chance that the auditor uses a clean opinion. It is that the auditor uses clean opinion. The chance that the auditor uses clean opinion when in reality, by clean opinion, it means stating that the financial statements are free. Clean opinion means stating the financial statements are free. Material misstatements, when in reality they contain material misstatements. When in reality they contain significant errors or fraud. So, audit risk is a chance that the auditor expresses a clean opinion, which is to mean that the financial statements are free from material misstatements when in reality they contain significant errors or fraud. It is the risk that the auditor expresses an inappropriate opinion. In other words, it is the risk that the auditor expresses an inappropriate opinion. It is the risk that the auditor expresses an inappropriate or erroneous opinion. Because we know auditors are required to express an opinion on the financial statements. They are supposed to give their opinion as to whether the financial statements are accurately presented in line with an applicable financial reporting framework. So where an auditor expresses an opinion that is not appropriate, that is what you are referring to as audit risk. So the concept of audit risk is fundamental to the auditing profession because auditors aim to give or to provide reasonable assurance that the financial statements are free from material misstatements. Auditors are required to give assurance that the financial statements are free from material misstatements. That means that while auditors strive to detect and report on all material misstatements, there is always an inherent level of risk that some of these errors and frauds may go undetected. So audit risk is the risk that the auditor will express an opinion that is not appropriate. And audit risk can be broken down into three interrelated components. All right? Three interrelated components. In defining audit risks, it's important for us to briefly define these components. Audit risk, there are three components. One is inherent risk. There is inherent risk. We have control risk, understand countries. Inherent risk. We have detection risk. Inherent risk, detection risk, control risk. Now, inherent risk is the susceptibility of an assertion about a class of transaction, account balance, or disclosure to a misstatement material either individually or when aggregated with other misstatements before consideration of any related internal controls. That is to mean, candidates, that inherent risk arises from the nature of the business. It arises from the complexity of transactions, the industry, and the entity's environment. For example, a cash-based business generally will have higher inherent risk due to the ease of misappropriation or complex financial instruments or highly judgmental accounting estimates inherently carry more risk. Another example is companies in rapidly changing industries like technology or fashion may face higher inherent risks related to inventory obsolescence and so on. So inherent risk arises from the nature of the business. They arise from the complexity of transactions. For example, I've given an example of a business that deals a lot with cash. If a business transacts mainly in cash, whose assets are mainly in liquid, then there is a higher inherent risk because of the ease of misappropriation of cash. Cash is easily misappropriated. And therefore, auditors assess inherent risk based on the understanding of the client and its environment. And it's not easy to control inherent risk, but the assessment influences the extent of the audit procedures. Then number 2, we have control risk. Control risk. Now, control risk is the risk that a misstatement that could occur in an assertion about a class of transaction, account balance, or disclosure, and that could be material, either individually or when aggregated with other misstatements, will not be prevented. It is the risk that errors or frauds may not be prevented or detected or corrected on a timely basis by the entity's internal control. It is the risk that errors or frauds or material misstatements will not be prevented, detected, or corrected on a timely basis by an entity's internal control. So control risk relates to the effectiveness of the client's internal control system. So if a company's internal controls are weak, or if they are not designed or operating effectively, there is a higher chance that errors and frauds will occur and go undetected by the company's own systems. For example, you may have lack of segregation of duties, e.g., where one person handles cash and records sales. That increases the control risk. Or just ineffective reconciliation procedures or inadequate authorization processes can lead to higher control risks. And the auditor's role in regard to the control risk is to evaluate the design and implementation of internal controls and perform tests of controls. So a higher assessed control risk means the auditor will need to perform more extensive substantive procedures. Then number 3, we have detection risk. This is the risk that the procedures performed by the auditor to reduce audit risk to an acceptable level will not detect a material misstatement that exists and that could be material. So detection risk is the risk that the auditor may not detect these material misstatements. It is the risk that the procedures performed by the auditor to reduce audit risk, you understand, will not detect material. So detection risk is in relation to the auditor. Detection risk, I repeat, is the risk that the procedures that are performed by the auditor to reduce audit risk will not detect a material misstatement. And detection risk is entirely within the auditor's control. But we saw that inherent risk is not within the auditor's control. Detection risk is entirely within the auditor's control because it arises from the possibility that the auditor's own procedures, like sampling, like analytical procedures, like substantive tests, fail to uncover unexisting material misstatements. And factors that could increase detection risk include inappropriate audit procedures. If the auditor has inappropriate audit procedures, then that will lead to detection risk. That will increase detection risk. That will increase the chance that the auditor will not detect material misstatement. If the auditor has inappropriate audit procedures, if the auditor has selected an insufficient sample, that's another example, then that will lead to failure to detect material misstatements. If there are also errors in applying audit procedures, the auditor in applying audit procedures is also committed errors. That will not help the auditor in reducing detection risk. There could also be misinterpretation of audit evidence, poor planning or supervision of the audit, and so on. All those are factors that can lead or increase detection risk, which is the risk that the auditor won't detect material misstatements. And therefore, candidates, what will be the auditor's role in relation to detection risk? Now, auditors aim to reduce detection risk to an acceptable level, an acceptably low level through careful planning, appropriate audit procedures, adequate testing, proper supervision, and so on. So there is an inverse relationship between the risk of material misstatements and detection risk, such that if the assessed risk of material misstatement is high, then the auditor must set a low detection risk, meaning they need to perform more extensive and rigorous substantive procedures. So just briefly, we try to define this concept of audit risk. That's all our today's lesson. The lesson was to just define audit risk, and in defining, briefly went into the types, the components, which now helps us deeply understand what audit risk is. We've said that audit risk is the risk that the auditor expresses an inappropriate opinion when the financial statements are materially misstated. It is the risk that the auditor expresses an inappropriate opinion. And there are three components of audit risk. We have the inherent risk, control risk, and detection risk. So the concept of audit risk acknowledges that the auditor's opinion is a form of an assurance. The auditor's opinion is a form of an assurance and not a guarantee. So by understanding and managing these three components, auditors can design and execute an audit strategy that provides reasonable assurance that the financial statements are free from material misstatements, thereby minimizing the risk of issuing an inappropriate opinion. You understand, candidates? Yes, that's the meaning of audit risk. Bye-bye.